Your money-making broadcast starts now. Good evening. Today is May 25th, Monday. Here are the top stories moving the markets. While U.S. equities are closed for the Memorial Day holiday, the silence in New York is masking a growing tension in the global markets. We are staring down a high-risk gap opening this Tuesday, fueled by a dangerous combination of extreme overbought technicals and a looming macroeconomic showdown with the PCE price index. Before we dive into the big stories, let's look at where we left off on Friday. The S&P 500 closed at $745.64, the Nasdaq at $717.54, the Dow at $506.12, and the Russell 2000 at $285.12. In the volatility space, the VIX is sitting at 16.59, which is firmly in the complacency zone. In other assets, we are seeing bond yields stabilize with TLT at $84.68, while Bitcoin and gold continue to act as the primary hedges against the systemic risk we are currently monitoring. The 32-day bull run has been impressive, but as any seasoned trader knows, the longer the run, the steeper the potential fall. Our first big story today focuses on the complacency trap and the elevated gap risk we face heading into Tuesday's open. As of the last close on Friday, the S&P 500 sat at $745.64 and the Nasdaq at $717.54. On the surface, it looks like a victory lap, but Java's analysis reveals a darker undercurrent. The VIX is currently at 16.59, which is approaching the lowest levels seen since late 2025. When the VIX dips into this complacency zone, historical data suggests we are at our most vulnerable. According to the Delt Macro Framework, when volatility stays significantly below the long-term average of 18 to 20%, the probability of a sharp gap down increases. We have a 3-day long weekend where global news continues to accumulate, and the signals are mixed. Bank of America recently issued a bull capitulation signal, suggesting that the last remaining skeptics have finally jumped on board. When everyone is bullish, there is no one left to buy. Javas warns that we are seeing a recursive loop where extreme optimism meets a technical ceiling. With the RSI for the S&P 500 at 72 and the Nasdaq at 74, we are firmly in overbought territory. In the world of professional trading, an RSI above 70 combined with a bullish capitulation signal often precedes a 2 to 3% correction within 5 to 7 trading days. For investors, this means the easy money phase of this 32-day bull run may be hitting a wall. The key question for Tuesday morning is whether the momentum carries over or if the market opens with a gap that triggers a wave of profit-taking. Moving to our second major story, we dive into the consumer paradox and the warning signs emanating from the retail sector. While the broader indices are hitting 52-week highs, we are seeing a divergence in real-world consumption data. Lowe's has issued a consumption alert, signaling that the American household is starting to pull back on discretionary spending. This is a critical pivot point. If the high-end consumption trend breaks, it ripples through the entire economy. However, we are seeing a fascinating split. While home improvement and durable goods are flagging, experience spending remains incredibly resilient. Take Carnival Corporation, for example. Despite the Lowe's warning, the cruise industry is seeing a massive surge in demand. This suggests a structural shift in consumer behavior. People are prioritizing memories over materials. Javas analyzes this as a K-shaped consumption pattern. The risk here is that if the macroeconomic pressure becomes too great, even experience spending will crater. We must also consider the impact of AI integration into the consumer landscape. Alibaba's recent AI chip announcements are putting pressure on the global supply chain and changing how we think about the cost of computing. For the investor, the lesson is clear: do not trust the headline index. Look at the sectors. The small-cap momentum in the Russell 2000, closing at $285.12, suggests that investors are trying to find value outside of the magnificent giants, but this rotation is fragile and highly dependent on the next set of inflation numbers. Finally, let's analyze the macro powder keg, the upcoming gauntlet of Federal Reserve and economic data. This is a high-impact week. On Wednesday, we get the May FOMC minutes, but the real volatility drivers are Thursday and Friday. Thursday brings the second estimate of Q1 GDP, and Friday delivers the April PCE price index. The PCE is the Fed's preferred gauge of inflation, and it is the single most important number for the next 6 months. Javas points to the Dalio long-term debt cycle framework here. If the PCE shows a month-over-month increase of 0.3% or more, it could fundamentally shift the market's expectations for interest rate hikes. Currently, the predictive markets are pricing in a rate hike as late as July 2027, but a hot PCE print could pull that timeline forward significantly. If inflation proves sticky, the higher-for-longer narrative returns with a vengeance, and those overbought RSI levels we discussed in Story 1 will become the catalyst for a sharp sell-off. We are also monitoring the bond market. TLT is stabilizing around $84.68, forming a head and shoulders bottom. This suggests that bond yields have found a temporary floor, but they are coiled like a spring, waiting for the PCE data to decide whether to spike or slide. The intersection of a potential GDP slowdown and an inflation spike, stagflation light, is the nightmare scenario that Javas is monitoring closely for the remainder of the month. Looking deeper at the PCE implications, this Friday's print carries outsized significance because it represents the Fed's preferred inflation gauge. If core PCE comes in at 0.3% month-over-month or higher, the market will immediately reprice rate expectations. The CME FedWatch tool would likely show increased probability of a July 2027 rate hike being pulled forward. Bond markets are already pricing in this risk, with the 10-year yield showing sensitivity. For equity investors, this means growth stocks with high valuations face the most immediate repricing risk. Value and defensive sectors, by contrast, may benefit from rotation. Javas recommends watching the 8:30 a.m. Eastern window on both Thursday for the GDP print and Friday for the PCE release for volatility spikes that could present tactical entry or exit opportunities. The VIX at 16.59 leaves little room for error, and a 20-handle VIX would signal genuine fear re-entering the market. The options market is also signaling caution, with the put-call ratio at 1.53 for open interest, suggesting excessive bearish positioning. Paul Tudor Jones would remind us that when the crowd becomes too bearish on options, it often creates a contrarian bounce opportunity. Javas interprets this as a short-term bullish signal within an otherwise cautious macro framework. To recap today's themes, we are navigating a market defined by extreme technical overextension and a dangerous level of complacency, all while waiting for the PCE price index to determine the fate of our interest rate trajectory. The momentum is strong, but the risk of a gap down on Tuesday is elevated. Now, let's move to the Javas recommended 4-stock lineup for the upcoming week. For the safe-type play, the father of modern value investing, Benjamin Graham, would choose Cisco Systems (CSCO) at $120.41. With a cost basis of $95.67, there is a substantial 26% margin of safety. The company is showing structural recovery in networking equipment demand and maintains a fortress-like balance sheet with consistent dividends and buybacks, making it a low-volatility anchor for any portfolio. For the balance-type play, the legendary Wall Street fund manager, Peter Lynch, would choose Carnival Corporation, CCL, at $25.98. This is a classic understandable business play. Consumers are shifting spending from goods to experiences, and CCL is the primary beneficiary. Despite the recovery, the price remains well below pre-pandemic highs, offering a compelling blend of growth momentum and value recovery. For the growth-type play, the world's leading innovative fund manager, Cathie Wood, would choose Advanced Micro Devices, AMD, at $467.51. While it trails the market leader in GPUs, the demand for customized AI chips like the MI400 creates a massive S-curve growth opportunity. The recent 3.99% bump on Friday shows that the momentum is returning to the AI challenger. Finally, for the low-cost type play, the legend of growth stock discovery, Phil Fisher, would choose Salesforce, CRM, at $180.07. Fisher would value the aggressive R&D investment into Agentforce AI. The SaaS subscription model provides a rock-solid cash flow floor, and the current valuation allows entry into a dominant cloud leader before the AI monetization fully hits the bottom line. Looking ahead to next week, keep your eyes on the 8:30 a.m. Eastern Time window on Thursday and Friday. The GDP and PCE prints will likely dictate the volatility for the entire month of June. If we see a cooling of inflation and stable growth, the bull run could extend its lead. If not, we may be entering a period of significant correction. Stay vigilant and manage your stop losses tightly. Thank you for joining us for this Memorial Day special briefing. We will be monitoring the global markets throughout the night to prepare you for Tuesday's opening bell. I'm Chloe. Subscribe to stay ahead of the markets every single day. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.